years, now extended for another 5 years. And for the REIT, the foreign source income was also exempt. That also expired. So now the foreign source income exemption for the REIT is also extended by another 5 years. Maritime finance incentive. Now the maritime finance incentive will expire on the 31st of March 2011. But if you look at MPA, they have to talk to shipping companies, large shipping enterprises, very early on to encourage them to come. So that's why the minister has decided to extend the incentive a year before its expiry. So now the expiry for the MFI is extended by 5 years from the 1st of April 2011 to 31st March 2016. Ship management. Up to now, ship management is not incentivized. So ship management is normally taxed at the normal corporate tax rates. However, recognition is given now that if you look at the shipping environment, shipping actually effectively is a tax-free industry. So the government has now decided to also exempt income from ship management under Section 13A. 13A is exemption section for ships, okay, well, for operations of ships. Deferring import GST. We know that when we import goods, we have to pay GST on its importation. But we can actually avoid paying GST on importation of goods if we apply for major exporter scheme. But not everyone can qualify for MES status. So if you don't qualify for MES status, then you have to pay GST on its importation of goods. What the minister has proposed is now we can actually defer paying import GST on the importation of goods. So he indicated that the deferring will be for at least 1 month. I would hope that the deferring will be up to the time of the filing of the return, because then it becomes useful. For example, if our filing quarter is, say, to 31st of March 2010, we have to file our return in April. It would be good if the deferral is given until April, so we claim a credit. Instead of refunding us the credit can immediately be set off against our liability with customs. So that will work very well. Another interesting development, the GST time of supply. Now, for GST purposes, at the time of supply, the trader has to account for GST. So currently, the time of supply is the earliest of 3 dates: the date when goods are removed, the date of our tax invoice, or the date of payment. So the earliest of these 3 dates will be the time of supply. And if you are completely tax compliant, you would have to track exactly when the goods left your factory. Because if the goods left your factory first, which is usual, and then your delivery order or dispatch order is sent to the accounts department where the invoice is issued, and the time of supply will take place when the goods were removed. We have the 14-day rule. The 14-day rule says that if you issue tax invoice within 14 days of goods removal date, then time of supply will be invoice date or payment date. But nevertheless, we have to track when goods leave our factory or have been delivered. So to simplify the whole process, going forward, we will not look at when goods are removed. We simply look at invoice date and payment date, which is a lot simpler. So we do not need to worry about when goods left. So simply look at the accounting system. When did we issue the invoice? When did we receive the payment? So this is actually a very good proposal. which will make complying with the GST requirements a lot simpler. Let's look at individual income tax. Again, as with corporate tax, there was a lot of representations for reduction. The rationale was, well, companies tax rate 17%, individual tax rate 20%, so we should reduce and harmonize the corporate tax rate. If we look at corporate tax and individual tax, generally the two are the same. The top individual tax rate is the same as the corporate tax rate. But over time, when we reduce our corporate tax by 2%, by 1%, income tax did not follow. And last year, it was especially difficult for the government to reduce individual tax because we had a recession year. So if you look at the taxpayers' profile, only 1/3 of our working population pay tax. And of this 1/3 who pay tax, less than 1%, probably 0.5% will pay tax at 20%. So very high income earners. Of course, that includes all our ministers. They pay tax at 20%. So it's very sensitive to reduce corporate tax rate for very well-off individuals. So it was difficult, but since our economy was recovering, there was a lot of hope that individual tax rate would be reduced. But we forget that election is coming. So I think the government wouldn't want to reduce corporate tax, and then Sylvia Lim, goes on and say, well, the ministers only have themselves vested interest, so no reduction. Maybe next year after election, we'll have reduction. So if you look at our tax rates, the top rate is still 20%. But we keep on talking about the top rate. We forget to talk about the average rate. When you look at income of 320,000, the tax is 42,700, an average rate of just under 14%, very low tax rate. So we have to look at average, not looking at just the top rate. If we compare our average rate, here we are looking at an individual married with 2 children having gross remuneration of 200,000. We in Singapore, we only pay 9.17%. Hong Kong, our perpetual competitor, is at 10.8%. More than 1.5% above us. Then you have Japan, over 15%, but all the way up is India at 29.4%. And not far behind is UK at 28.55%. But the UK rate of 28.55% will not be there for long, because with effect from the 6th of April 2010, the top rate of individual tax in UK will go up to 50%. That's why I have a lot of inquiries from US-based expatriates wanting to come to Singapore. Yeah, if you look at them, if they come to Singapore, they will pay 9% as opposed to over 40%. So if you include national insurance contribution, they will be close to 50%. Well, we just had a casino open on the 14th of February. Our sands will open in April. But casinos not only involves gambling, but you have performances. So what the minister has indicated is, well, we must bring in global recognition and exciting acts. So he has decided to reduce the tax of non-resident public entertainers from 15% to 10%. So the next time you see performers in Resorts World, you see performers in Sands, they will be paying tax at 10% flat rate. no longer 15%. Slight changes to personal reliefs. A new